Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to someone who is really way smarter than me, way successful than me, Neil Timmins. He hails from Des Moines, Iowa. And I was just talking to him that I had invested in Davenport market and I'm actually investing in Des Moines market. So by the time this episode is published, most probably I would have met Neil in person. So in 2004, Neil was a banker. The same year, his mother had her debut year as a realtor, and she made twice what he had made. That is amazing in 2004. So Neil just decided that real estate is the way to go. He became a realtor with Remax, and his team was recognized by the Wall Street Journal as a top 100 team. And he was the #1 Remax agent in Iowa by 29. That's amazing. And by the way, Neil also shared his book with me. It's called Unicorn Hunting. Hope you guys can see the book. So I'm going through the book. It's pretty interesting how you can pretty much scale up and build your real estate business. So thank you, Neil, for this. And welcome to Wealth Matters podcast.
Alpesh, hey, thanks so much for having me. I'm excited to be here with you.
Absolutely. So Neil, the first question we always ask everyone is, tell us something interesting or funny about yourself.
Something funny about myself. Well, yeah. How about interesting? I've got 3 younger brothers. I grew up in a household, very competitive household. All of us played sports, and I was an all-state lineman, and I also played tennis, believe it or not. So I was darn near 300 pounds when I played. I played then in college, the University of Nebraska at Omaha. So that's how I ended up over there, played on scholarship, but I also played tennis in high school. So you can imagine playing against me doubles, me right at the net. I stand 6 feet, 5 inches tall.
Oh, you are 6'5". Oh my God.
Yeah. So it was quite an intimidating factor when I played tennis. Now my son is a sophomore in high school. He plays tennis as well. And so he's got his first competitive match tomorrow. It's all day long. So I'll be attending that. And I'm excited to get out there and watch him at the net, just like I used to be.
So good luck with his first competitive game. And by the way, I'm a huge tennis fan. I used to play as well.
Sure.
And I have seen from Pete Sampras, Andre Agassi live to all the way to Roger Federer, Rafael Nadal at US Open.
Yes.
So I have seen all of them pretty much play. I was just crazy about it. And of course, Jennifer Capriati to Serena Williams as well. So
it's such a great sport. It's so much fun to take that in.
Yeah. I think I compare swimming and tennis because it's like full body workout as well. And it's a great sport, concentration wise as well. So no, it's amazing. We will have some more things to chat other than real estate when we meet. Yeah. So you became realtor, right? And I understood that. So you got the bug of that. You saw that real estate is the way to go. But
right.
Did you invest in real estate? And what was your first real estate investment?
Yeah, it took me about, let's say I'm ballparking 5 years or so, maybe 6 to buy my first investment. At the time, I even for years past my first investment, I thought the idea of having tenants was just terrible, too much work. Couldn't conceptually get my head wrapped around how I would properly and successfully manage that. So I bought an investment property, fixed and flipped it. And then I did one more, did a handful of those for a few years before I ever bought one that I kept.
Oh, wow. So when was that and how did that work out for you?
Yeah, the first several were all great. I want to say it's about 2010, 2011, somewhere in that era.
That's a good time.
It was a good time. But I was flipping. So it would have been better had I kept the property.
Oh,
right?
Yes.
Yeah.
Two things, the appreciation and second, the taxes.
Correct. Yes. Yeah. So I just, would go in, was able to find a crew and just one after another. Again, not a lot. I would do 2 or 3 a year. Whenever I would stumble across something that I just thought was a good deal as a realtor, I'd stumble across it in my normal course of business, showing people houses, and I just I'd pick one up here or there.
Okay, no, that's pretty interesting. So then you started buying real estate, and so I heard you are also transitioning from houses to commercial real estate. Why?
Yeah, no, that's a good question. And I'll back it up to kind of give you the genesis of how I got into holding property and then why I'm at the
Sure.
crossroads in which I'm at. So just over 5 years ago, about 5 years and 4 months ago, was the first house I ever bought that I kept.
Okay.
And so I was like, you know what, let's try it. Bought it, kept it, great, relatively easy to manage it myself, even to this day. It's nice, solid B class property. Negligible issues, no big deal stuff. And then I bought the house next door, and then I was like, cool, let's just do a few more. So I just kept buying more.
Correct.
I was going, you know what? I think there's something to this. And so I started morphing my realtor business and shifting my focus to go, all right, let's do, 25% of my business this year needs to be investments. So I would buy and keep some, and I would fix and flip some, and started morphing over that way. And about somewhere 2 years ago, plus or minus 18 months ago, I finally got to a point where I was going, I'm all in on investing. All my income is derived from either fixing and flipping or passive income. About 3.5 years ago, I bought my first commercial asset, and I've subsequently bought another half a dozen assets at this point, all on the commercial side, from retail, which we had chatted a little about before we got on here, to industrial, to apartments, to medical offices. So I've bought a number of varied assets through the market. And you're right, we're making a transition. I say we as a team, making a diligent transition to go, all right, now how do we shift and go 50% of our business needs to be coming out of commercial assets. And so that's a focus for us this year and moving forward to get deeper and deeper into the commercial side.
So two questions I have. One is, what kind of commercial assets do you want to focus on? Because you mentioned industrial to apartments. Like, is there one asset which you would like more than the other asset? Or
Yeah, it's a great question. So some people find themselves with tremendous comfort level in assets in one asset class across multiple markets. I find myself in a tremendous comfort level in multiple asset classes in my market. I understand my market well, and I'm able to, a lot of the properties, there's a lot of similarities between an office, for example, and between an industrial building. Although the properties are different, when you put them on a spreadsheet, the spreadsheet's the same, right? You've got a tenant, you've got a lease, you've got a certain type of lease. And so they all pencil out in a similar fashion. They have different lease rates associated with them. But they're fundamentally on paper, very similar. It's relatively easy to get one's head wrapped around. Then it becomes, in the marketplace, what's the demand? What's the appetite? Supply and demand. Can you get them? Can you keep them leased? That piece is a little different. So, largely for me, it's been identifying properties where there's value associated with it. Right.
Okay.
In today's day and age, we hear a lot about value add apartments. I'm trying to find value add in just about any asset class in my backyard.
And that was going to be my next question. And I'm glad that you specify or mentioned it, that which market are you focusing on? And you mentioned, so it's mostly Des Moines. And what is going on with Des Moines market? I know pretty much every real estate market is on fire now, right?
Sure.
From single family, right? And that's what most of the newbies or most of the, investors or house owners compare against. But what is going on with Des Moines market?
Yeah. That's a great question. So yes, of course, the single family's on fire just like everywhere else. But what Des Moines has going for it, for where it's at now and where the trajectory that it's on, is if you think of the Midwest, you've got Kansas City, you've got Chicago, Minneapolis, Omaha, and we're kind of in the crossroads. We're really in the crossroads of all four of those locations. But Des Moines is the fastest growing city in the Midwest.
Oh, okay.
So what we have taking place on our side, and again, it's not like the South. This doesn't look like Austin, Texas. We don't have people going up in droves from California. Like, nobody from where you live is moving here, right?
Yes.
But what we're getting is people from the other sections, largely other parts of the Midwest, are moving.
And I heard Illinois, New Jersey, New York, it's losing population. Even the Massachusetts, and they're moving to Midwest, cheaper.
It's less expensive, and it's tremendous. There's great job opportunities. We are a financial center. If you think about, but what are our jobs made up of? It's heavy insurance, a lot of white collar jobs here.
Oh, I see. Okay.
We're the second largest insurance city in the United States, next to Hartford, Connecticut. Des Moines,
Oh,
Iowa is number
wow.
2. So
Wow.
we've got a tremendous amount of white collar, highly educated jobs that are here that pay well, and the cost of living is still awfully affordable
Yes.
today.
And the reason I asked is it's not for me, for my listeners, because just
Sure.
a disclaimer that, and I mentioned it to you that we are closing on that commercial retail shopping center in Newton, Iowa, which is close to Des Moines. And also we are looking into buying another commercial shopping center in Des Moines or a mobile home park, because some of my operator partners already own like 4 or 5 mobile home parks in Des Moines market. So I exactly know what's going on with Des Moines. So thank you for sharing that.
Absolutely.
And the reason for this podcast, I want to talk about the looming issue with our government right now. And I think who else could be a better guest than you, who has been doing working as a real estate broker, who has done flipping and also investing in a lot of different commercial real estate. Is that government is left with 2 choices right now: inflation or recession. Do you know which one is coming, or can you take out your crystal ball and tell us, and why?
Well, you may have both.
Yeah. That's true.
Do I see option number 3? Both.
Yeah.
It's an interesting situation that we're in right now. And you know, what happened about 14 days ago, plus or minus, is that the yield curve inverted, which is typically a sign of a coming recession in the near term. The last time the yield curve inverted was about 2019, somewhere in 19.
And we thought it's coming, and then COVID happened and everything switched, right? When we started money printing.
Correct. Rates were on a point in 2019 going into 2020 where everything was creeping higher. All the conversations that I was taking place in, and the mastermind, the groups that I plug into across the country as you go into Q4 of 19 was, you got to take some money off the table.
Yes,
as fast as you can, because
I started selling as well.
there's something, it's coming. And then you go into COVID and that kind of delayed it. Now, and not only did it delay it, it made it worse in many regards. We have printed so much money, and
trillions of dollars,
and have forced a level of appreciation that or a level of inflation that we have not seen in 40 years at this point. I went back and, the last time we saw inflation at this level, about, that early to mid 80s, 82, 83, 84, somewhere 80s, in that range. And so that's the last time you saw inflation at this level. The big difference right now is that inflation was at that level then, but the 10-year treasury traded from about 11% to 14% in that year. Today, maybe it passed 3% intraday trading, but it was about 295.
Wow.
We're about 10% off on the 10-year treasury rates from right now compared to the last time we had inflation at the same level we have today.
Right. So that's even worse.
Correct. So, it makes you think, when the 10-year treasury has doubled, gone from 1.5 to 3, let's call it, from in December to the day we record this. So 4 months, that we're moving very hard, very fast.
Yes. So is one better than the other for real estate investors? Like, is it inflation better or recession better? And can you explain how?
It's a good question. I think what you'll see from an inflationary standpoint, the answer, of course, always is it depends.
Right.
How far is inflation going to run up? Yeah. What one could see if we find ourselves in an opportunity, and I'll call it an opportunity because I think there's tremendous light at the end of the tunnel.
Yes.
If we find ourselves in an opportunity that looked like 1975 to 1985, those of us with the intestinal fortitude to stay the course in real estate will find ourselves with potentially the greatest opportunity we've ever seen in our generation.
Okay.
Better than the housing crisis of 2010.
Really? Okay.
Because if you think about if you look at a chart over the last, just look at the 80s to today, what's happened is that you've got interest rates on a steady decline for the last 40 years.
Yeah.
And asset prices, as a result of an interest rate decline, accelerate in a very big fashion. So if we find ourselves in an inflationary environment that ultimately will have to be offset with increased interest rates at potentially double-digit levels, it depends on how hard inflation, how high it goes, and how long it stays there. Yeah. But if that's where we find ourselves, what we should see is some falling of asset prices,
Increase cap rate, right? If inflation goes up.
increase cap rates. Yes. So we should find ourselves in a position where if we can stay the course, meaning buying some things at double-digit cap rates and stay the course for 5, 10, 15, 20 years, you're going to be extraordinarily well rewarded. I mean, generational wealth can be built.
And I think the one thing you mentioned, it depends, right? It's because are you buying right now or are you selling?
Correct.
Right? As a real estate investor.
Yeah, you're exactly right. Now, some of this has me giving thought to, are we buying, are we selling? And if we're buying, who's our underlying tenant? Because what's implied with me saying you may find yourself in a tremendous success over a period of a couple of decades or so is that you have to make it through. And so that means if we find ourselves in a recession, it means some businesses are going to fail.
Correct.
And that means increased vacancy. So when you're buying a place, who are your underlying tenants? What is the credit risk? Yes. What is the risk you're taking on? And some sections of the industry, for example, we bought a couple assets in 4 months ago in December. We've got orthodontist office. I happen to think that an orthodontist would make it through a troubled time.
Yes, I think so.
And there are other segments of the industry that we don't own, but other segments of the industry that are much more choice related, if you will.
Correct.
Maybe some frivolous retail, let's call it, that I would go, that might be one of the early things that does not make it.
Interesting. So, and how can, investors like me invest during this recession, right? This high interest rate environment. What do you look for? What are some of the gotchas?
The biggest things I'm looking for is who are my underlying tenants. And then if I've got a good tenant, I want to proceed ahead, move forward to place an investment. It's locking interest rates up for as long as I possibly can. And I know that for some folks, and I had multiple conversations with lenders this week, and they're telling me, hey, some of these 3-5 year ARM products, people are opting for shorter time frame for their interest rates because they're getting a lower interest rate than you would on a 7 or 10 year product. Yep. But they believe that interest rates are going to come down over the course of the next 3 or 5 years. I'm not so optimistic on that.
I don't think
so. I would opt to go lock me in for a 10. As long as I have some flexibility on prepay, I will overpay. We're obviously paying to hedge that 10-year rate versus a 5-year rate, but I'm okay doing that because I can sleep better at night knowing that I've got an extended period of time for whatever's going to transpire in the economy to transpire.
So that is recession, right? And how can, let's say, if we just continue to hit inflation, how can investors invest and protect themselves during inflationary environment?
During an inflationary environment, it's again, underlying credit risk. Who are your tenants? Long-term interest rates locks, and then be mindful of what you're buying. Here's an example of that. I think you'd be better off buying some things that have bumps. If you're going to buy commercial assets, bumps in the lease rates. Apartments have been a tremendous hedge. And the reason I think apartments are such a draw for folks right now is because let me ask you, Apesh, when somebody leases an apartment, how long is that lease good for typically?
Yeah, it's at least 12 months, but usually they end up staying like 12, 24 months or so.
Correct.
Yeah,
you're exactly right. But that lease is typically 12 months. And
yes.
what the benefit of an investor that we get at the end of 12 months is that we can decide to do something with the rent. We can raise that rent. So I think you'll be able to ride the an inflationary environment better when you're in an apartment type product because you can reset that annually. Versus, for an example, if you're
like office building, triple net or something, 5-10 years.
5-10 years, 10. Well, an example, you know what? A Dollar Tree, for an example,
yes.
a fresh 10-year lease. So you got a 10-year rate right now, plus 2 5-year options, to the exact dollar for the next 20 years, what your potential income on that building is.
Correct.
Can't change it.
Yeah, you can't change it. Yeah.
Right.
Oh, that's the great point. So, can you talk about the latest acquisitions you have done and why, if you can talk about one or two?
Sure. Yeah. I'll give you the one, probably what I think is the most interesting and creative one we did in December. Will that work?
Yeah, sure.
So this has a creative strategy component to it. And then, kind of a hedge in terms of where we're going. In terms of why we took it down. So there was a portfolio that came to market, 3 properties, and there was non-uniform, meaning of the three properties, I'm going to round here. Say it was $9.5 million for all three properties.
Okay.
One of the properties had a value of about 7.9 million.
Oh, wow.
So overwhelming majority of it, right? So really non-uniform, some interesting components to it. And I ended up making an offer on the whole portfolio.
Mm-hmm.
And what I'm told is nobody else did. They made offers on pieces of the portfolio, but the seller did not want to sell the thing in a piece. They wanted to sell the whole thing at one time.
It's a pain. Yeah.
Correct. So I ended up contracting the whole thing. And what I ended up doing is connecting. By circumstance, I ended up connecting with a couple of brokers who clients had interest in the largest component of that portfolio. So I took that and I wholesaled off the biggest piece for 7.9 million. So I took the portfolio, had it under contract, wholesale that piece off for 7.9 million. And I retained the other two buildings, both orthodontist office, single tenant, triple net lease, orthodontist. And it was about, I'm rounding again, say about $1.5 million is what I ended up having left in the two buildings. Okay. It appraised for 2.5 million.
Oh, wow. So up front, you had forced appreciation without doing it.
Forced appreciation without doing anything. Ended up taking it down, put it on a 10-year fixed rate.
That's awesome.
Yeah.
That's amazing. And what has been your best real estate deal so far?
Well, I think that's yeah.
That's
it's tough. I have not had, $1 million of net equity at close. That's right. That to date, that's the number one.
That's great. And have you had any deal go south? And what did you learn from it?
Yes. I mean, there's been a couple of single families, which we purchased where, I think our total losses are under $7,000. I mean, so
that's not too bad.
No, I mean, it's pretty negligible compared to, we typically flip anywhere from 80 to 100 houses a year. So we're very active on the house side. So to be negative $7,000, I want to say 3 deals stick out in mind. What did I learn? Oh, the one thing I learned is the very first one I lost money on was a dome home. You know what a dome home is?
I don't.
It literally is a house in the shape of a dome.
Oh, wow. Okay.
Yeah. And it's super, I mean, they look like bubbles.
Oh,
super weird. What I learned on that, I thought I was a genius to begin with because I bought this property, it was mismarketed in my opinion. I bought the property. I literally like 3 days later, I put it back on the market for sale, marketed it correctly and put it under contract. And I looked like I was going to make 35 grand in weeks. Well, what ended up happening is that Fannie Mae and Freddie Mac do not finance dome homes.
Oh,
yes.
Wow.
So you can't get conventional financing, which means you're stuck to bank, like commercial grade
lender or credit unions.
So that happened. That thing kapooted out. I did it again, sold it again, looked like I was going to make 30 grand, kapooted out, did it again, thought I was going to make 25 grand, kapooted out. And I was like, okay, I got the idea here. There's a problem.
Just got to get.
Yeah. So finally ended up sold it to a dude on I think we made a couple bucks on it, but not worth the time, energy, effort. Sold it to a guy on contract, and he ended up keeping the property. And then eventually the DNR, the DOT, the Department of Transportation. Oh, they came in. He was like one house off a corner. They came in and paid him like 3 times what he bought it for me for 5 years later. So he killed it. I felt great for him.
Right.
Yeah. So what I learned is like dome homes, berm homes. So homes built into the side of a hill.
Oh, okay.
Non-uniform. If it doesn't meet Fannie Freddie guidelines, if they cannot and will not finance it, don't buy it.
I see. Oh, that's a great advice.
Yeah.
Any other gotchas you have seen throughout? Because I can tell you have been a broker, you have done flipping, you have done wholesaling, and moving into commercial. What are some of the gotchas?
Some of the gotchas, I think a lot of this has to do with being honest with all people at all times. I think one's reputation matters. And if I think when you think through what's this going to look like in 3, 5, 10 years from now, if you're a person who's in this game forever, right? You want to be in this thing forever. You got to be mindful of what you're doing at all points in time. And I think there's a bunch of people today, given how good the market is and how quickly, some people think they can move a buck, that they'll just do anything to do that. And I'm here to suggest, some period of time from now, they won't be around. We just got a lot of characters coming out of the woodwork today. And I think it's imperative to just do things right from the get-go, and knowing that it's not always about today. For me, it's about playing this game and having fun and making an impact until the day, I'm called above.
That's such a great advice. I totally agree. And I want to now talk about the book itself and the unicorn hunting for real estate investment companies. How did you get the idea to write this book?
Yeah. So the book is all about, when we say unicorn, I'll put some reference around that, or frame of reference. It's about hiring. So how to successfully attract, screen, and land a unicorn, what I'm calling a unicorn employee.
A person. Yeah.
Yep, exactly. And so how I got this, I've hired poorly for some time, for a number of bad hires. And I finally got to a point, where it was time to grow. And that was largely over the course of now my 18-year career. I've made some bad hires, right? And so I was getting to the point on the investment side in the last 3 years or so, where I was going, all right, it's time we've got something going here. Let's create a team. Let's get the right folks in the right spots. Mm-hmm. And we got to a point where COVID came about, and I had a hard time hiring locally.
Yes.
Terrible time hiring anybody.
No one wanted to work, man, when you hand out free money, right?
Correct. Nobody wanted to work. So I was at a point where I was going, you know what? I got to pivot. I need to understand how I can successfully onboard and build a culture and build the right people remotely. And for me, that has meant, I'll put some for reference around that, has meant remote US based. So that's what it looked like. And I was in the middle of COVID going, all right, let's do this. How are we going to be able to do this? And it started internally with going, I needed to find what this place is. What are my core values? What are our core values as a business? What's the culture that we're striving for? And that became the lens, really the line to go, this is how I hire and fire based on these core values. And so I literally had to fumble and continue to test till we got to a point where I was going, cool, I got one unicorn. Now let me do this and see if I can hire it again and get another unicorn. And we ironed this and really dialed in the process to be able to get that. And a process for me is, you got to be able to have, just like you, just like anybody else, needs to be able to take the same action and get a predictable result. Yes. And that's what we were able to do. And 80% of that book is standard. I'll call it standard operating procedures. It is, here's how you do X, Y, and Z to walk everybody through the process. There is no theory in that book. It's literally, about every template's been provided for what to do and how to do it.
And how many team members do you have now?
Right now, our core team is 5, with half the team being remote.
Okay. And where are they located?
Out of Arkansas. So Nowhereville, Arkansas. I don't even, the population's like a few thousand, a couple of thousand. It's very
still
tiny.
All US based.
Yep, exactly. Still all US based. You got it.
Got it. Okay. No, I'm going to apply this because I'm growing. I have one virtual assistant right now and growing like crazy and pulling my hair out on how to do all this. So I'm going to apply this principle right now as wonderful. Well. So how has this worked out for you overall, the remote and all? And are you happy with how it is, or are you going to hire locally?
No, it's so much, for me, it's so much easier to manage remote people. And part of that is understanding our core values, knowing what it is that we value, how we go to hire and how we fire. We just attract the right people. Lou Holtz was once asked, the famous Notre Dame football coach was once asked by a reporter. The reporter asked and said, hey, everybody you've got on this team is excited. They are motivated. How in the world do you keep all these players so motivated? And Lou Holtz replied, it's pretty simple. I just don't bring the people on who aren't motivated.
Right. Make it easier.
Team's made up of people who are self-motivated. And so when we were able to hire that way to go, okay, and manage based on KPIs, not how we feel, but based on what are the actual results that we hold people standard for, accountable for,
Right.
management became a breeze.
Oh, that's awesome. Thank you for sharing a lot of golden nuggets with us.
Yeah.
Let's take a quick break. And after the break, we'll go through the same questions I ask every guest.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. I highly recommend anyone getting started in real estate, go through this episode, inflation, recession, and how to invest, as well as if you are growing, then I would say that go ahead and buy the book by Neil Timmins, Unicorn Hunting. It's a great book so far I've been reading. I think I'm going to apply the same principles to my real estate business. So thank you so much, Neil. Are you ready for fire round?
Bring it.
Okay. Would you be changing any business or investment strategy after this pandemic is over?
Yes. And it's largely focused on moving upstream to bigger assets, bigger dollars and cents.
Favorite real estate or finance or any other related book other than yours and mine?
My favorite book of all time changed my life when I was in my early 20s. The Millionaire Mind by Dr. Thomas J. Stanley.
Yes, that's I have read that book. That's a great book too. Yeah. The Millionaire Next Door, The Millionaire Investor, The Millionaire Mind. Yeah, awesome. Thank you. Any tool or website you recommend or you cannot live without? Maybe it's related to real estate business. Maybe it's for hiring.
Yeah, for us, what I cannot live without is our CRM. We use Podio, and then we've got a custom skin on top of that. So I couldn't live without it.
Yeah, I was going to say Podio for most of the real estate brokers and the flippers or the wholesalers.
That's right.
Any advice for beginner investors?
Just keep moving, keep moving. And I think my best advice would be find a mentor, find somebody you can connect with, latch on to, you can learn from. People have walked before you. Do not try to reinvent the wheel. Connect with people, figure out how to add value to their world, and you'll get exactly what it is that you're seeking.
I agree. How do you give back?
How do I give back? I give back in a number of ways, largely to this community by having conversations, by partnering with folks in the community, in the real estate community. Just love talking to people, and certainly newer people, because I recall all the mentors that I had along the way and still have to this day. Wouldn't be here without the folks who made deep impact in my personal life and business life.
That's awesome. How can my listeners reach out to you?
I'm going to give you two ways. First, I want to do something great for your audience. That you can get the book on Amazon if you like. It's $50. Why is it $50? The cost of a wrong hire is $15,000. So spending $50 is no big deal. But I'm happy to. You guys pay for the shipping. I'll send you the book for free. Just go to www.landaunicorn.com. Landaunicorn.com. Pay for the shipping. I'll send you the book. So I wanted to do something for your audience. You guys can find me on, you bet. You guys can find me on LinkedIn. You can find me on Facebook at Neil Timmins, or on my website, Legacy Impact Partners, legacyimpactpartners.com.
Awesome. We'll put that in the show notes. Thank you so much, Neil, for your time.
Thanks for yours. I appreciate being here.
Absolutely.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!